But, um. Right, welcome. Let me just get these links out to everyone. But yeah, welcome to the stream. Okay, officially, the Fed has increased the Fed fund rate by 0.25% as expected. Um, so yeah, so it is 25 as you wished. Yeah, it's going to come in as expected. Jerome Powell isn't going to come in hot. So yeah, came in as expected. Let's see how things, well, where things are going to go. Now, I mean, obviously, as mentioned, things were going to be the screen. Oh, okay. Think I'm going to. Okay. All right. Let me know if things change. Yep. 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 Okay. It should be normal now. Okay. Beautiful. Yeah. I mean, as expected, things are going to go up. Things are going to come down. Okay. It's going to be volatile. Essentially now, obviously, we've got the interest rate in, right? So 0.25 as expected. The data or kind of the strength in the rest of today is how Jerome Powell is coming in and what is being said. Okay, as mentioned in the previous updates, it's all about that terminal rate, that forecast for that terminal rate. How high is it going? Um, yeah, that's where it's all at. So let's see. Keep an ear out for what's happening. Um, we're getting some sell side. The sell side is coming in now. Again, we did say 29. Okay, it has just hit shy of it. Um, quite glad that we cashed out of our trades. A little bit early, but we cashed out anyway. Profit is profit. Yeah, so we'll just watch. We'll keep an ear out for what is said, and if Jerome Powell decides to increase that terminal rate, then we are in short because that is going to trigger some sellers. Some sellers. But this is as you can see. I mean, Bitcoin's touched and gone into that area. That'll be mapped out, and your dollar index is in that area as well. We're seeing a little bit of support here. We're seeing a little bit of a rebound. Just bear in mind, we do have this other area beneath the current area that we're at, and finding a little bit of support is a decent level. As you can see, previous structure here, 1, 2, and now potentially a third. So again, this could be a nice rebound. We do want it. We want to see something like this, like a candle like this. Huge wick on the bottoms. Ideally on the hourly, on the 15 minute, we're getting that buy side follow through as well. Okay. I'm trapped right now. Yeah. So you need to be careful with these data points. Which direction have you taken the trade? Buy or short, or long or short? Sorry, shall I say? It's a dangerous thing to be in. Um, yeah, it's not it's not an ideal situation. That's why we got out. I'm on long at the moment. You best hope Jerome Powell says nothing different, because if he comes in, this could very much turn around heavily. Okay. Um. Yeah. Just just make sure your stop loss is set. Because things could turn around. Just be on the safe side. Um. Things can definitely turn around. Have one. How you doing? You okay? Welcome, welcome, welcome. Let's see what we can get here. Now, as mentioned, okay, we were in trades. We cashed out in profit ahead of this news. Again, as mentioned, we did say things are going to be volatile. Okay, uh, it's safer to stay out. Just let the data come in. Let Jerome Powell say what he has to say, and then take a position. Okay, there's always another position, especially around something like this, which is extremely important. You need to bear in mind this is the rate hike before the rate hike and FOMC meeting before the end of Q1. Okay, this is also important because of what we have been talking about in terms of um, the market expectations. Okay, 0.25 and the pause next interest rate decision in May. Okay, so if Jerome Powell decides to say something else, say that okay, rate hikes are going to be kept going up, or keep going up for longer, essentially increasing the terminal rate or the forecast for the terminal rate. Markets have not priced that in. You can expect a massive sell-off. Okay, this will dump heavily. You're seeing a little bit of sell side coming in on the lower time frame. It's nothing too crazy at the moment. Um, yeah, it's essentially just a little bit of a rejig. Okay, that's all that's happening here. I mean, it's relatively unchanged, but yeah, this happens all the time. Okay, yeah, it's coming as forecasted. So um, it's what said in the speech. Okay, now Christine Lagarde. Um, Hi there, Ismail. How you doing, my man? Welcome, welcome. Um, yeah. Christine Lagarde is came in hawkish, even though um the whole Credit Suisse situation. So I mean, Jerome Powell hasn't got the greatest record in terms of really standing his ground, um, or ramping up, shall I say, in terms of the hawkishness that he comes in as. So maybe something switches today. Okay, again, guys, don't. This is why around these important like meetings and speeches and stuff, it's best to stay out. If you're on the wrong side, you're just going to take an unnecessary loss at the moment. It's not worth it, especially how detached markets are compared to the Fed. The markets are very, very, very optimistic. We might get bearish news and the markets pump. Okay, or vice versa. So we'll see. Very, very. The markets are very unpredictable around this point. Okay. Um. Yeah. Yeah, but those that are joining us on the live, welcome. Make yourself at home. You feel free to ask us anything in the chats. Um, yeah, we'll listen to the Fed speech. We'll watch price action, see what's happening. Um, Again, what we're listening to or listening out for essentially is the terminal rate being bumped up? Is it increasing? Okay, that's what the markets want to know. That's what they want. Parveen, hello, my man, welcome. Um, yeah, it's gonna be volatile. 29k short, maybe. I mean, 29's that area's already been tapped into. I'm not seeing that sell side just yet. Seeing a little bit of sell side on the hourly, seeing a little bit of a pickup, but nothing crazy. Markets are going to move up, down, up, down, up, down, and then in either direction, depending on what is said. In 8 minutes' time, I think I heard right. Um, but yeah, we could break down or we could push up. Okay, you've got a target between 30,000 and 32,000. Okay, that's if we really ramp up. If we ramp down, I mean, yeah, we could ramp down heavily. So we'll see. Are we waiting for Jerome Powell's speech? Yes, 100%. We're waiting for Jerome Powell's speech. We are not doing anything. As mentioned, we closed our positions. We were in nicely, took our profits earlier on for this breakout. So we actually got out a little bit early. We got out on this kind of wick back down. We didn't like the look of it earlier on. We got out. We cashed out in profit. We were holding positions since 2 days ago, I think, if I'm right, or yesterday. So we'll catch in the move somewhere around this region here on this rebound. Um, so yeah, we closed out. We cashed in the profits. It's the safest bet. And I would just sit on the sidelines, let the price action do its thing, let the market do its thing, um, whilst we get the speech. The interest rate decision, as mentioned, came in as expected. Um, yeah, the market is hoping for a pause in May. Um, that's what they're pricing in for. So anything that deviates from that, markets are not priced in. We have been ramp we have been pushing up for a while. Okay. Overall buy side volume has been declining, so bear that in mind. Okay. So if everything aligns in terms of a sell off, okay, the sell off, there's going to be a nice, very 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 nice short, very nice short. No, see, I mean, you see how overall volume has been declining. Look at this. You see how we're struggling. So there needs to be a bit of news for ramping up in price if it's to push up higher. I have a question. What trading app do you recommend? So unfortunately, I can't say anything that's kind of third party apart from TradingView. Okay, otherwise I get banned, which I have unfortunately been banned for doing so. So if you want help with that, just message me privately, and then I can help you with that. But unfortunately, I can't. I can't discuss that on stream. So I do apologise. Are you streaming the speech? Yeah, the speech will be up. Don't worry, I'll get it up. We'll go through the speech together, guys. Don't worry. Yeah, if there's opportunities, we'll cash in on opportunities. If not, then that's all good. When will we know? Um, During the speech, right? It's essentially, but we're listening out for whether um there's any changes in Jerome Powell's stance or the Fed's stance after everything that's been happening, right? So the readings that we've had in terms of labour market, in terms of CPI, well, mainly CPI really, because we've already had a little bit of light in Jerome Powell's testimony, the last couple of speeches, um, and then obviously everything that's happened with the US banks. So obviously we've had quite a lot of development on that side of things. So um, Yeah, we'll see. Essentially, this speech is going to say you'll probably hear it in the probably first like 5 minutes, 5 10 minutes of the speech. Really, is where Jerome Powell obviously says his statement, and then he gets asked questions after that. So, um, yeah, it'll be soon into the speech. Da-da-da-da-da-da. See if it's where we can get it. Mm. Mm-hmm. Mm-hmm. I've got the speech up, so we'll wait until Jerome Powell actually hits the screen, and then I'll switch it over from the radio um, to the speech. I'll keep price action up. At least you'll be able to hear Jerome Powell. You don't need to really see him. He's not. Yeah. Those that are following and liking the stream, thank you very much appreciate it. Let's see what we can get here today, guys. Hopefully, we can cash in on something. Um, yeah, I mean, ideally, we want to hear. Ideally, I want to hear that the terminal rate is increasing. Then I can literally just get in on a nice short position on Bitcoin and just ride it out all the way down. Essentially, if the terminal rate is actually increased, I do think that that's the catalyst to really make, well, kind of kickstart a large sell off. If not, then I mean we'll see how things kind of play out. But if nothing changes in that speech, you're probably looking a push past this point. Yeah. Here we go. Alts are kind of bleeding. Yeah, they will be bleeding, mate. Um, yeah. Mm, yes and no. They're still looking okay. Mm-hmm. Beautiful.
responsibility of the Federal Reserve, without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median
Could
estimate
get a
of the
rebound.
longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside.
Okay.
Yet the labor market remains extremely tight.
Mhm.
Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months.
Okay.
The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up
Dollar index
recently,
is looking weak.
and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Core PCE,
Okay.
excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates
Woo!
pressures continue to run high. The
Bloody hell.
for total PCE inflation is
What's happening?
3% for this year, 2.5% next year, and 2.1%
Jesus.
in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
Why is nothing loading?
Despite elevated inflation, longer-term inflation expectations
Jesus, guys.
well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
That's some
My
sell
colleagues and I are
side.
acute that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment.
Okay.
In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward.
Mm-hmm.
If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals.
I'll tell you what, this guy is one of a kind.
We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will
He's keeping secrets from us. Yes, I do. What is he saying? Because it's frustrating.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe, that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough
So
review that will
he's not said anything different. Okay, the terminal rates
Given all of the stress and the uncertainty,
is not changing apparently.
how seriously was it
Um,
considered for this meeting?
but he's again, there's no clear direction in anything that he says.
to the meeting, and you see the decision that we made, which
If data comes in, it might change.
by a very strong consensus, and I'll be happy to explain why. And really, it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes.
I don't even know how to take any of that data or anything that he said really. It's very strange, and this price action is pretty bearish right now as well.
And all of the evidence
So
that the public has confidence that we will do so, that will bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
gotta let it digest.
So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike, and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Someone needs to fire him.
The difference between
Get him out.
rate increases and firming. Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
Thank you for the follows, by the way, guys. Very much appreciated. We're just listening out what's said, if anything else is said.
monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
So we've come straight back to the trend line. So we're still not too bad. I mean, we've got that fake out on the top, breached, and then come back down. Seeing quite a lot of sell side volume coming in, so we do need to be careful of that. Now, again, we're just sitting back, listening to what's said, how he's answering these questions.
Your forecasts, or those of your colleagues, or those of your board staff, incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago. We're trying to assess
Huge moves.
This is so recent, and it's people. It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And
Guess Litecoin's going for it.
The data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor markets, so that pointed to higher rates. And then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect.
People versus feds. Yeah, kinda. I mean, Jerome Powell really isn't helping the situation, to be honest.
To handle them.
Hi, Victoria Guida with Politico. I wanted to ask.
It's just, I mean, it's actually frustrating listening to Jerome Powell talk. It's really frustrating.
To allow uninsured depositors to be protected at these two banks. I was just wondering if you could
Like,
speak
he
to
literally just doesn't give any sort of material at all.
Or was there a concern?
No, it's just beating around the bush.
Economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and
Yeah, the systemic risk.
That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision.
Wants to crash crypto for his digital. I mean, he's not said anything. If he really wanted to crash it, he would have said, okay, I'm increasing the terminal rate. Terminal rate, or the forecast for the terminal rate unchanged. But as said, if anything changes in terms of data, I'll amend. There's a chance that it could push past the 5.1%. So, yeah, I don't even know how to take it, to be honest. We'll keep an eye. I mean, he's not changed anything. Okay, he's kind of left it on just you're in limbo. So, if we follow what the markets have been following, okay, markets been doing one thing, the Fed's been doing another, essentially. So, if the Fed's unchanged, then I presume essentially when the meeting is over or close to this speech is over, that this could potentially actually uptick back up. So yeah, I mean, for now, we continue just watching price really. I'm not going to take any rash decisions, but
in February and we still don't have now is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious
yeah.
why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet.
This evening's trading session is going to be interesting. Okay, so once this speech is over, the markets, we should see a little bit of volatility come in.
Potentially quite real.
So yeah.
Use for being alert as we go forward, as we think about further rate hikes. For us, we will be paying attention to the actual and expected effects from that.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit. I know that you've got your internal review coming, but I wonder if you could talk a little bit.
I mean, this
about
could
what you
very
do
much
with
just
oversight at Silicon
bam
Valley Bank, and
breakthrough.
whether it suggests that something about regulation and supervision needs to
That
actually
30k
forward. And I wonder, how
could
can
be
we
looking at
confident
30k here.
that there aren't other weaknesses out there in the banking system, given that this one
Let's have a little look at.
noted?
So let me
Look at that, guys, straight down.
to the questions around supervision. So at a
You
basic
can
level,
look at that.
Silicon Valley Bank management failed badly. They grew the bank very quickly.
So we passed that first. Now we're down to the next level of support on the dollar.
Supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than historical record would suggest. So as for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong?
And terrible management. That's what's happened.
And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear.
Seeing a bit of volume, which is nice.
Clearly, we do need to strengthen
That
supervision.
30k area does look very nice.
I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something?
Yes, this is the important question.
You're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing.
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime,
He hasn't got a fucking clue.
and obviously, at the end of the day, we will do enough to bring inflation down.
Stud's not got a clue, has he? This guy is astonishing.
Hi, Chair Powell.
Really
Rachel
is.
from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy.
Seen a bit of a
There's
rebound
also
here.
growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks.
Essentially, what you're saying is he has no clue,
risk that could mimic
and he's waiting for more data.
we saw with SVB to banks disproportionately
That's
hurt
basically what you're saying.
commercial real estate.
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is
He needs to go.
is resilient. It's well capitalized,
Hmm.
and I really don't see that as at all analogous to this.
By the way, guys, don't take any first,
An outside investigation.
unless something's obviously said, of course, which nothing has been said, and it's quite clear.
Of course, we welcome that.
It's quite clear.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume
Oh my
we take
gosh.
fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
If I could follow on that, but they're working, the spending that's happened is working against what you were doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
This guy.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago.
Thank you for the likes on the stream, by the way, guys. Yeah, just letting the speech be over and done with. As you can see, we're just moving up and down, up and down, up and down. Because Jerome Powell is giving us absolutely nothing to go off. Absolutely zero.
13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements. But it seemed to be the right place. So with the FDIC, we're lending to the. In effect, we're lending to the Bridge Bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Thank you, Chris Rugaber and Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will. I think for now,
okay, we got a little bit.
As I mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%.
Oh my gosh.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of.
Have a little look at what's happening with the S&P. We're down slightly. Russell's down. Nasdaq slightly up.
Liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from what we.
Getting some sell side, that's for sure.
Through purchases of
longer-term look at this.
Large-scale
rebounding.
Long-term securities are really meant to alter the stance of policy by pushing up the pricing, down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really.
Now we're getting some blood. Guess it was kind of what was said on that last part where interest rates will be increased if it needs to be. But again, I mean, who knows what the data is going to come in at? That's essentially what he's saying. I'm going to wait for the data. If the data looks worse, I'm going to increase interest rates. But I mean, we're at 5%. So essentially, we're at the terminal rate, right? Or the max, the forecast. So it's if the data comes in hot, yeah, markets are just going to melt, because essentially that's going to put pressure on increasing interest raits. So this, I mean, there's quite a lot of sell side on these alts. Bitcoin dominance is making a fall. It's going to be interesting. By the way, guys, we will continue with this stream after the speech. We'll see whether we can get some positions. We'll see if we can get that break. We're at that trend line, as you can see. We are seeing some nice sell side. But yeah, it could very easily turn back around. So just be careful. We don't want to take any rash decisions.
Long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently engaged, very much engaged with the bank repeatedly and was escalating. But, nonetheless, what happened happened. And so that's really the purpose of one way to
quite a lot of sell side.
Vice Chair Barr is conducting is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that. The speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations?
Yeah, I guess everything that needs to be said has been said now, so it's a little bit more direction. We'll see how it kind of reacts off this level here.
Simon Urbanovich with The Economist. Thank you very much.
It looks like we're seeing a push back up in prices, so
Are you saying that de facto deposit insurance covers all savings? Should Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors?
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system.
could potentially get a short here. Let's see.
And I think depositors should assume that they're
Coming down. Got a potential nice short, yeah.
I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley?
Right, we're taking a short position here, guys.
Go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief?
We've taken a short position, just letting you guys know.
We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Yeah, this is looking
Thank you, Chair Powell. Nicole Woodkind.
good to
CNN
go.
Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions
Let's see.
in the labor market, and it's a highly uncertain estimate. And I mean, there's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if
This is probably your first level of real support. It's 25, 4-ish. And that's a nice turnaround. So
years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your or projections in your policy?
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. You know, the models all work in kind of linear ways. You get more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know necessarily how significant it will be. And so, you know, we're very focused on getting inflation down, because we know.
Yeah, I mean the market's clearly bleeding, guys.
That's how we can have a long. You know, we've had very strong labor markets.
Yeah. So targets. Okay, so we got 25,500 as first target, and then 22,500 as second target.
And the reason was inflation wasn't forcing the central bank to come in.
Yeah, we'll see how things kind of react. This is kind of your real first kind of point at that 200 moving average. See how things kind of react there. We're currently up 120% on this short, so yeah, there's that joined in. Well done. Again, this is why it's kind of important to join in on these lives, because the signal actually got sent a little bit after, so
with all the events of the past
yeah, things move fast.
Do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped.
So you got that level there, but I mean we've breached through. I mean that's a large candle, and we're getting some nice volume on it. So yeah, it's 26,800. That 200 is your first real hurdle, but this is looking weak right now. See that nice sell side coming in on that hourly. Now we're not going to trade any alts now. Yeah, things have moved. I mean, just look at that. It's blood all across. Yeah, we'll just this is what I'll put on the screen for you. Bear with me.
Serious regulatory, in particular immediate attention. That's and I guess there were 6 of them.
Copy.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about.
The sniper is printing, not the Fed. Yeah, we are printing. We are printing.
Well, I'd see if I did, I wouldn't share them because I really, you know, this review is going on. And,
right, that's your signal, by the way.
Nothing other than us to find out what happened,
yeah.
Figure out what we can do to do better, and then implement those changes. That's all I want.
This is why you got to be patient. You wanna. It could have gone either way, guys. It really could have gone either way, especially with what was being said. There's not anything of real substance being said. I think that where he really started to see things ramping down was when he was asked on the potential continuation of rate hiking, okay, past the current terminal rate of 5.1%, and he said, yeah. But he didn't increase the forecast for the terminal rate. So essentially he's saying, okay, if the data gets worse, expect increases in the interest rate. Which, I mean, you're just still leaving me in limbo. I still got to wait for the data to come out. So I guess there's going to be a little bit of a pricing in for that. Okay, so there's going to be a little bit of a sell-off on the expectation that, okay, maybe we get worsening data and the interest rates go past the current terminal rate. So he's just leaving markets in no man's land, basically. But just be careful. There could be a very quick turnaround, that's for sure.
Financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily necessarily capture lending conditions. So we think that though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question
I mean, we're up 140% at the moment on that trade, so average price 27 from 5 to 3, 27.
There's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. So, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our.
Yeah, the entry could have been a little bit better.
I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
Well, then there you go.
That's all I have to say. That's one way of wrapping up a news conference with Chairman Powell down in Washington, D.C., live from New York City. Good afternoon to you all. This is Bloomberg Surveillance, live on TV.
Let's see how things kind of react. We could get a rebound here. So just be careful.
A rate hike, but they considered a pause, and he was keen to communicate they don't see rate cuts this year as well. Here's the price action for you on the S&P 500, down about 0.5%. It was higher about 30 minutes or so ago. We turned lower. Likewise with the Nasdaq, we're now down about 0.1% also. In the bond market, though, this move sticks. The 2-year yield down by 20 basis points, 397. Let's call it. Let's round that up for you. On a 10-year, we're down about 12 basis points to, let's call it 350. Just about sub 350 at 348.66.
Looks like we're getting a bit of a rebound.
Euro dollar looks like this, 108.76, positive about 1%. That is a stronger euro. That is a weaker dollar. Lisa, what's really interesting about this meeting?
Yeah, we're still looking weak.
At the same time Chairman Powell was speaking, the Treasury Secretary was as well. And arguably in the last hour, you could make the argument that the most important headline came from the Treasury Secretary and not the Fed Chair.
100%. Fed Chair Jay Powell was boring. I mean, let's be honest.
Exactly.
It was a boring press conference. He didn't really say anything other than we're not sure. We adjusted our projections
Exactly.
and really towed the line. But Janet Yellen said she is not considering a broad increase in deposit insurance despite all of the discussions around some sort of blanket deposit insurance. This is spooking the market, and you can see that immediate response in markets. So at what point is this counter-programming? Jerome Powell comes out and he's saying everything's fine, we have complete confidence in the stability of financial system, and she's here kind of raising questions about what the backstop is going to be for some of these regional banks.
So we asked the question through the last hour, in fact the last couple of days. Can you take the financial instability of the last 2 weeks and work out how it equates to interest rates?
It's a nice sell-off. We just need those sellers to follow through on the lower time frame. Still looking weak.
We're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then
Might be worth actually moving that stop loss to break even.
So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions.
This underpins a massive difference between the communication from this Fed chair today and what you've heard from President Lagarde in the last week.
Yeah, exactly.
Experiences in this banking system in America right now very different to the experience in Europe. There is a real belief on the committee at the Federal Reserve, communicated by the Fed chair, that they believe, like many people do, have spoken to us in the last couple of weeks, that the financial instability will lead to tighter credit conditions, and that could be a substitute for the tightening through rate hikes that this Fed could deliver.
He specified it's hard to know exactly how much, and he couldn't come up with a model like some others have come up with.
Okay, exactly.
Pin that down, but they're trying to game it out anyway. I mean, you're noting that, and basically, there has been a market shift in the expectations. Again, a lot of this it really hinges on the stability of the financial system, and so I do wonder why he didn't really discuss deposit insurance and how important that was to the banking system, especially as Janet Yellen went out there and was like, "Yay!" and that's not really going to happen.
Do you think that's clearly because he wanted Treasury Secretary Janet Yellen to take care of this herself? Knew that she was speaking at the same time?
You know, I'm not going to speculate. I mean, I can speculate, but it's not really going to help. It's not going to help anyone. I'm just wondering what the communication here is in terms of policy, especially because you need the political will.
There is no communication. That's the problem.
At a time when it's unclear that they can get really much done. I mean, we're still talking about not getting a budget passed wonder how that's going to be the fly in the ointment for this whole messaging procedure at a time when he was successful. It was boring. He didn't really make any waves, and that is an absolute rip-roaring hallelujah.
And that's a big achievement, considering how tense, how difficult this moment was for this Federal Reserve. If you are just tuning in, welcome to the program. A 25 basis point hike from the Federal Reserve. We had a statement, we had some projections, we've just had a 40-minute news conference or something like that. In the statement, they previously said at the last couple of meetings that the committee anticipates ongoing increases in the Fed funds rate. That's been replaced now. The committee anticipates that some additional policy firming may be appropriate. He was asked about what that means, policy firming. He said the important words here, Lisa, are some and may. Some and may. That there might be some, and it may happen. I guess you can read into that whatever you want to read.
Exactly. Oh my gosh. Right, we're moving our stop loss to break even.
They're saying we don't know. We're watching things the way that you're watching things, and we're not going to rock the boat, but we still do see inflation being an issue. Basically, they've been listening to all of our commentators and representing all of their views in a perfect way to not rock the boat. My question is just, are we going to step away from this, saying Janet Yellen kind of did it for him? Should we work through the projections?
Yeah, get Janet Yellen in instead of this geezer, 'cause he's useless. Alright, we're at break even, so risk free now. Okay, so just let things, it could very much rebound here, just who knows. So we're still looking weak, some nice sell sides. If it pushes back up, we're probably going to move towards that previous trend line where we broke out from. So yeah, just let it do its thing. That's our trades. We're at break even.
But you can see, based on the projections and the ranges there, that there is a pretty wide range of views about where they think rates are going.
Okay, get this. I can't get over this. 2025, someone has their dot at 5.6%, and someone else has their dot at 2.37%. So try to square that. I mean, basically, you have a 2.5 to 3 percentage point gap between those two. We don't understand where we're heading. I just wonder whether they're going to really be guiding or whether they're going to be following the market. And the market gave them an opening and they took it.
Just an extra line on financial stability and what the Fed chair had to say in the news conference. Remember that line from Senator Warren in the last couple of days? It was on Face the Nation on Sunday, where she said, this chairman, he said all he wants is looser financial.
Alright, we're out.
He said, I plan to support stronger supervision and regulation.
It's pointless.
Put that to bed now.
Let's get out of that.
That's what the Fed's going to be pushing for.
He never came out and said, all I want is looser financial conditions and less regulation. That's not probably an accurate depiction of what he said. There's still are questions.
So we're out of break even, by the way, so we'll see how things kind of potentially move here. Okay, maybe get a move back down, or we're moving straight back into structure. So this looks like we might be coming down a little bit. Yeah, does look like we're going to get a rebound.
Now that one's interesting. To what degree? To what extent? To what amount? We know the FDIC limit, 250,000. We thought maybe that's going to get changed. Inevitable. We were just trying to work out what the number might be. The Treasury Secretary's comments in the last hour may be muddying the water a little bit.
A little bit. I mean, this was one of the proposals on the table, was some sort of broad increase in deposit insurance.
Right, yeah, we're out of break even, guys.
Increase in deposit insurance. How much are hands high when you look at Senator Schumer as well as McCarthy, both sides of the aisle?
Let's see if we can get something.
To have anything that could be skewed as a bailout in some of the political.
Some of these, yeah. See, that's going. We're going. Let's try and tap into something quickly here.
Perhaps some of these officials would like to see.
Let's get down to DC and catch up with AMH. Anne-Marie, your latest read on the latest comments from the Treasury Secretary.
Well, it goes against some of our reporting, but we should note that it is within the Treasury Department's purview to do the due diligence, to look at potentially if they have to do this again, to expand the FDIC, something that obviously we know mid-sized banks are asking for. But Janet Yellen, the Treasury Secretary, didn't mince words. She said that at this moment, not something that we have looked at. So potentially it hasn't gotten to her desk, or potentially it's not in a place where they'd be making a decision on it, but our reporting is that the Treasury Department was doing this due diligence. Not something to invoke risk, but just something that they wanted to make sure they could have.
Litecoin is moving pretty heavily here. Now, bear in mind, guys, I mean, we have done a post on Litecoin. Litecoin's halving is this year. I think it's in June, if I'm not mistaken. Okay, so it's going to ramp up.
Well, I think there are a couple takeaways from this. One is that the
That's your structure that we're moving within.
System aside, still concerned about inflation, still worried that they are not tight enough,
And Bitcoin dominance is coming down. So, as Bitcoin does its thing, we will get some of these altcoins really pumping.
So the banking situation doesn't seem to have affected the course of monetary.
Is this actually live? Yes, it is live. Yeah.
Banks, though, is that Powell was
This isn't recording. It should say live on your screen.
very badly managed. They did the wrong things, and that while there's an investigation into what the Fed did wrong, this was basically a couple of bad banks, as opposed to.
By the way, guys, those that are following and liking the stream, thank you very much. Very much appreciated. Yeah, so obviously we were in on a short on Bitcoin, seeing if we could get a continuation to the downside. Failed to do so, so we moved our stop loss to break even anyway, so we're out with no loss. Now we're just seeing what the overall direction's going in now. By the looks of it, yeah, we found a bit of resistance. US dollar, Swiss franc. Let's have a little look. Now, there's an interest rate decision on the franc tomorrow. I'm pretty sure. Was it CPI? Let me just double check. Yeah, interest rate decision. So, just see if we're at any sort of key level. We're at kind of this level of support.
If there was a shift, I think it was more towards uncertainty. I don't think it was anything to do with the recession or pullback. The Fed still thinks inflation is the biggest issue, and the Fed still wants to stay on its policy path. There's a little bit more of a willingness to say if things go south.
I wouldn't be taking a short just yet. Coming up to this level of support.
Rate cuts are not in the cards right now. They're going to have to wait and see. They don't know what the bank problems are going to mean in terms of credit tightening, but some of that credit tightening from the banks may be exactly what they're looking for.
I mean, there's still a little bit more room for this to come down.
No, I don't think the Fed at this point has
yeah, we could come down a bit further. We've got this wider range here, right? And then we've got some tighter liquidity just here. So it could be the case that we make that push here and then maybe rebound, build up some structure, either come down or move up from there. But just bear in mind, obviously, we've got a Swiss interest rate decision tomorrow.
Are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of what's going to happen?
But this is looking like we could come down as well. That the dollar does have a little bit more room for things to come down. Patience, patience, patience.
And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes.
Joining us now to discuss, Bill Dudley, former New York Fed president, and currently, of course, Bloomberg opinion columnist. Bill, you've had some time to process all of that. What do you make of it?
I think it was pretty logical what happened. Basically, the Fed is saying that, one, uncertainty's gone up a lot. We're not really sure how long the banking system stress is going to last.
All right, we're going to go long on Litecoin.
Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier. But I think the real key is something that Mike McKee talked about. Uncertainty has gone up. Uncertainty has gone up a lot. And I think it's sort of interesting that markets are not really fully focused on that, because the risk of a hard landing is higher now, because the Fed isn't going to really know what's the appropriate policy to do.
Yeah, exactly.
A lot more information.
Yeah.
It's going to take time for that information to be received. And it's not going to be very easy to assess how are these banking laws going to affect credit conditions and how much is that going to affect economic growth. So I think that we're actually in a worse place today than we were a few weeks ago because they're just, there's two forces. One force is keeping inflation high. Another force is slowing the economy down. And we don't know which one is going to
Some more structure. We'll see whether we can get up to this order block here.
Bill, the easy way to dismiss any conversation around the Fed is just to say they're data dependent. I hear that so much. They're going to be data dependent. But Bill, at this point, I'm wondering, what data are they dependent on for the next decision?
Well, I think the problem is that the data on the effects of credit tightening on the economy take a while to actually be realized. We have two sort of open questions about the banking system. Number one, how broad is it going to be? How many banks are going to be affected? Number two, how much are banks that are affected actually going to tighten their credit standards? The problem is not a credit problem. The problem was actually banks taking on too much interest rate risk. So it's not obvious to me that tightening credit standards is really the logical response. And number three, how long is this going to go on? So I think that there's a lot of uncertainty.
Yeah, let's see if we can get push up.
How much of a breaking effect
Just need some very nice volume here, so.
The fact that the Fed basically has one more rate hike and then keeps rates high throughout the year suggests that at this point they don't think that this is going to exert a lot of downward momentum on the economy. What's interesting today is the market reaction to the Fed's press conference and the statement and the summary of economic projections was to be ever so slightly surprised by the rate hike because it wasn't fully priced in. But it actually is pricing in more rate reduction in the rest of 2023 and into 24 than they were earlier. And I think that was a little bit surprising, frankly, given the fact that Powell was very clear. We don't expect to cut rates in 2023.
Does that open up a question about the credibility of the Fed?
I think it opens up a question that people are just very uncertain about what the banking system will mean for economic activity, and then how does that actually translate to the Fed. I think people are worried about the downside risk from the banking sector.
Steve Chiverone of Federated
It's not nice breathe now.
I think it's a really salient point. This meeting marks the passing of the torch from inflation and duration risks, he wrote, to recession and credit risks. Arguably, what we have seen is not a credit crunch. However, often liquidity crunches can lead to credit crunches, as we've seen in the past. Bill, do you agree that this really is a tipping point as represented to some of the changes in the statement?
I think it really depends on how broad and how long. We've had other examples where there's been all sorts of market turbulence and no recession resulted. The most obvious example of that was the 1987 stock market crash, where people were talking about making analogies back to the Great Depression, and the economy didn't go into recession at all. So I think the real issue here is how many banks are affected and how strongly do they react. When I look at the U.S. banking system today, I see only a handful of banks that have actually been affected.
Thank you for the follows, by the way, guys.
Total banking assets. So I personally think that if this thing is stabilized right here, the effects on the real economy are going to be...
We're literally just floating into profit and back out.
We're only 2 weeks into this.
But, I mean, on the lower time frame, at least we got some nice structure to go to now. It could be the case that make a bit of a turnaround, maybe test the level here and then build up structure to go up again. So we just do need to be careful of what's happening. But it does look like, I mean, look at that reaction there twice off that support level, right? 1, 2. We even got a bit of a reaction here. So we got that dip, support, pushed up, came down, support. So we've got a decent amount of buy side coming in. Yeah.
So when the Fed chair says we're not thinking about cutting interest rates this year,
so I mean, this is probably the true direction of the market currently. Yeah. There wasn't much said, and you can hear it on the radio, right? Nothing much said. They're still going from data point to data point. Jerome Powell has no clue whatsoever. Okay, he's just literally taking data point by data point. So, yeah, we'll see.
Stronger than we thought. Inflation's higher than we thought. Oh, but we have had some banking system woes. What should we do to our forecast? Well, let's leave it basically unchanged.
Yeah, exactly.
And they're doing that because they just don't know which of those two forces predominates.
Yeah, exactly.
John mentioned that you could drive a truck through some of the economic projections if you take a look at the dots and how far apart the highest and the lowest are. I was really struck by 2025 dots and just the range of estimates from 5.6% to 2.5%. I'm wondering if you've ever seen anything like this before, where there is so little of a compass directing all Fed members, but even if they're on the
It's
same page.
ridiculous. It really is ridiculous.
On the same page in terms of if you told them what the economic forecast was, they would write down interest rate path that was pretty similar. I think what they probably disagree on is is the economy actually going to evolve? How quickly is inflation going to come down? What's going to happen to economic growth? Are we going to have a hard landing, a soft landing? And so there's probably just a lot of uncertainty about how the actual economy is going to evolve, and that uncertainty about the economic forecast, I think, has gone up. So the modal forecast contained in the summary of economic projections is not
A
changing
bit of a
very much at all,
rebound.
but the distribution, the probability distribution, has widened out dramatically, in part because of the banking rules.
Final question, Bill. Next decision is May 3rd. Is that enough time to get the
May 3rd, not May 9th. There you go.
We'll see. I mean, I think it's going to be either banking system stabilizes pretty quickly in the next few weeks, or we just have creeping problems. The problem that in the banking system is when the weakest bank gets into difficulty, that raises the stress on everybody else because everyone else gets more skittish.
Yeah.
All the people that are using the banks are much more skittish today than they were before Silicon Valley Bank failed, and so it doesn't take as much bad news today to generate the same response as a couple weeks ago.
Hey, Bill, this was wonderful, as always. Bill Dudley there, the former New York Fed president, currently, amongst other things, a Bloomberg opinion columnist weighing in on the decision from the Federal Reserve. Lisa, what a moment. Quite clearly, the takeaway for me after that news conference, after that conversation just there, when we talk about being data dependent, what are we really dependent on between now and that next meeting in early May?
How many more banks fail?
It's not CPI, is it?
Whether we get
It's
some
not
sense
payrolls.
of real credit tightening, right? It's all backward looking, and right now the president's moving so quickly, and that was very clear and very present, which is the reason why people seem to still be responding to what Janet Yellen is saying. She's still testifying in front of the Senate, and I do want to just give you a sense of what else she did say. It seemed like she softened her tone just a touch, which is the walk back that some people were expecting. She said, not time yet to say if FDIC insurance cap is appropriate. So, basically hedging and high, and you saw a revival in some of the shares of these banks. So right now people are tracking her comments probably more than any fallout from the Fed. But this to me was interesting. She said that deposits left Silicon Valley Bank at a pace that was never seen before. And this comes at a time where there is a new threat of, and people blame Twitter, people blame media, people blamed everything, but you can withdraw money at the tap of a phone, and that
Right, let's see if we can get a reaction.
and the protocol for banks that really rely on these deposits in a way that the larger complex of the banking world does not.
I've always said when these officials testify, they should have a Bloomberg terminal. Just a live feed of where markets are when they speak, just to sort of auto-correct them as they're going along.
I think maybe she does,
Tick
right?
for tick.
Maybe she was like, all right, walk that back.
Maybe. Jeff Rosenberg joins us now from BlackRock. Jeff, I think people are asking the question, was the hike today the final hike?
Well, I think Powell was very clear to try to indicate not only is this not the final hike, but that, to Mike McKee's question, that there's a real disconnect between what the Fed is telling the market in terms of their forecast and their expectations, and what the market is pricing in terms of cuts at the May meeting, as soon as the May meeting. So I think this meeting, is really
See if we can get a rebound.
dealing with the present crisis in the banking sector, and that unknown is really that's going to determine where we are in May. But
Here we go again, a little bit of a price action.
about why they changed the statement. They changed the statement. It was much more dovish because of the banking crisis. And then he went on to say why the SEP forecasts were relatively unchanged, and that was due to offsetting factors. The offsetting factors here is that if we didn't have this banking crisis, then this would have been a more hawkish result, and it would have been a terminal rate that probably went higher. He said that explicitly. Our path was probably going to be higher than what we had projected in the December SEP. So going back to what Bill Dudley said, I just want to add that the uncertainty grows on both sides. It's the tail risks that are increasing. And while most people are looking at the market and saying, oh, we're really worried about this banking crisis and the hard landing, uncertainty cuts both ways. And so the other way to think about the uncertainty here is that the Fed didn't do what it otherwise would have done, given the fundamentals of the inflation data that got very little attention at all to the question.
All right, here we go. We got some support coming up.
The focus in this meeting is distracted, perhaps rightly so, or perhaps, as we'll see, if this crisis fades, that it distracted from the fundamental issue, and that by not having
Here we go.
more, they raise the risk on the other side of a more persistent inflation outlook. So I think when we talk about uncertainty going up, which I agree with, it's a two-sided uncertainty.
Yeah.
I'm really glad that you brought this up, but I want to build
Getting
on
some
the idea that perhaps people are dramatically underpricing longer-term inflation as a result of not an artificial, but an interrupted rate hiking cycle that would have looked different based on the data. From your vantage point, is that the risk that is most underpriced in markets right now?
I think it is. It's a very asymmetric outcome right now. The market is pricing for the bank scenario. It's pricing for the last 20 or 30 years of Fed policy behavior. Financial sector stress leads to a Fed that pauses and that cuts. That's what we've seen from the Federal Reserve. And if the crisis...
Right, this is kind of your last point of support, right? If we break through here and we break hard, then, I mean, yeah, it's probably going to bleed a little bit more. That's kind of your area. You want to see a bit of a rebound with some structure coming in at that point. This is making a little bit of a turnaround, which is nice. So let's see if we can just get that continuation.
For the market's pricing, they're giving a lot of impact to future monetary policy and very soon to be cuts as a result of this event. But the extent, I think was the word he was using, is highly uncertain. And what we also have to talk about not only is the extent, but the marginal impact. Powell talked about financial condition indices, and they mostly don't measure this. And so if you look at bank lending standards, if you look at tightening conditions that incorporate that, you're going to use the survey of lending standards. And that has been showing a tightening condition for a very long time. Certainly, this event marginally increases it, but the question is really to what extent. And if this ends up like UK LDI, then this will be a lot less of an extent, and therefore the market is overpricing the amount of cuts that they should be taking out of the market expectations.
Market to one side, Jeff, I'm with you. It is a guessing game, but I believe the Fed's taken a stab at it. Because if we got an SVP 2 weeks ago, I think that rate, that dot, goes from 5.1 to 5.60. I think most people thought that was what was going to happen. So, Jeff, with that in mind, hasn't the Fed just told us that they think it probably equates to about 50 basis points?
Yeah, I think he even said, one, maybe some more. He was kind of anchoring to 25 or 50, and I think you can infer from the counterfactual on the SEP that is kind of the implicit projection. But it's highly uncertain.
Yeah, I think the market's going to move.
Question around, what are we going to learn between now and then?
Getting a little bit of sell side. We've got 18 minutes left on this candle. Realistically, I mean, things should have moved a bit more. We should have seen a bit more volume coming in. Still relatively, I mean, yes, it's a decent amount, but not... Again, as mentioned in the previous updates, we need to see lots of sell side, and we're not getting it. It's still relatively weak right now. We're at this level of support here. If it continues to hold, we will just rebound. Now, bear in mind, this is actually falling, so if we rebound on Bitcoin, some of these altcoins will pump. Okay, the ones that are looking a little bit more developed are the ones that are going to go.
Sounds like the inflation risk is just going to get parked and maybe throughout the rest of this summer until we get some clarity on what financial stability really looks like. Now,
we'll see.
Money to work against that backdrop, knowing that maybe this market might be less sensitive to incoming information, traditional data points, CPI payrolls, etc. How would you manage that?
Yeah, you're absolutely right, Jonathan. I mean, the banking sector crisis will happen faster. Its evolution will happen faster than the incoming inflation data. That's good in the sense that, you know,
See how we came down here, rebounded off that previous structure.
some of the other outstanding banks, that global issues seem to be becoming
Looking
resolved.
better now.
Get to that resolution quickly.
This is just,
Contagion effect, and they need to
if the market really wanted to really sell off, this would have been a lot shorter. For instance, okay, we would have made a much stronger move. Those areas of support would have been hit much sooner. You see how we came here, stalled, pushed back up, and I very quickly stalled again. If it was a very strong sell-off, okay, this would have been broken quickly. Now, don't get me wrong, there is still a chance. Of course, there is still a chance. We do need to see that buy side also come in for it to kind of set in stone. Okay, yeah, we're at support and we're going to rebound here. So there's still a chance that things can ramp up and continue moving down. But yeah, really should have happened much sooner. Now we can get another potential leg down towards that moving average that we touched on just here. Not there, on the 4 hour, sorry. As well as this level here, okay. And then start to structure up again. I guess the market is kind of really, okay, how am I going to take this, this speech? Again, nothing much was said, so I presume this is going to be relatively short-lived. But yeah, this is your area that you want to look for support, and we're getting it. So let's see. Find a bit of support on the dollar.
Hey Jeff, wonderful to catch up with you, sir. As always, Jeff Rosenberg there of BlackRock on the latest Fed decision. I think a lot of people walk away from this thinking Chairman Powell handled that well. History's going to be the ultimate judge. If this financial stability issue gets worse, then the 25 basis point hike was terrible. If it goes away and inflation stays elevated, it looks like it's the right thing to do, and that's why it's so difficult to be a policymaker confronting decisions like this one today.
Let's see if we can find support soon.
None of us know. We don't anticipate cutting rates. The market says, yeah, you're going to cut rates by almost a percentage point by the beginning of by the end of January. He says, look, you guys do what you want. We'll play it by ear. We've got the backs of banks. It was successful. It was not that interesting. He didn't, which was good.
Stay on the banks going into the close. That's what you need to watch. First Republic,
yeah.
17%.
Right, okay. Apart from that, there's nothing else to touch on. We've got current position open on Litecoin. We'll let it do its thing. I'm looking for support to come in relatively soon. We've got a little bit more space. We are within the area of support here, but yeah, this is the concentration just here, about 26,800. So yeah, I guess let's see how things hold up. Yeah. Things are looking like rebounding now. Again, as mentioned, that speech didn't really give much. So this is a little bit of pricing in terms of, okay, there's a potential increase in interest rates, but it's not. Basically moving from data point to data point. That's it. So the markets are going to continue doing their thing. So we'll see how well this holds. I mean, looking relatively weak, but we want to hold this 200 on the 1 hour ideally. Let's see. Yeah, well, we've come down. Yeah, let's see if we can get some buy side, yeah. But yeah, okay, amazing. I'm gonna leave you guys. I've got to take a call. But yeah, we'll update you where necessary. as always. But yeah, everyone that joined us today, thank you very much. We will put out a market update for you all this evening at some point. So just keep an eye out for it. It won't be on TradingView, just bear that in mind. Okay, so it's not on TradingView, it will be elsewhere. So make sure to check that out. But yeah, we'll put something out for you guys. We'll just let this price action do its thing. So yeah, enjoy the rest of your evening, and I'll see you soon. Thank you.